Hey everybody, welcome to the True North Retire webinar series. This week is really an important topic. We're going to go into taxes, and I think that's important because the tax deadline, which normally is in April, has been moved to July. So again, I'm Jake Rushton. If I haven't met you yet, I hope to soon.
My name's
This is
Brett Weston.
Brett does a lot of extra work for us behind the scenes. He meets with clients personally, has a background in accounting, has a degree in accounting, and really knows his stuff when it comes to taxes. I know enough to be dangerous, but I wanted to bring the experts. So that's why I have Brett here today.
Happy to help.
So we're going to dive into the topic today of really, it's going to be high level stuff. We're going to dive into some tactical things that hopefully will help you understand the tax system better. Because if there's one thing I've understood is that most of us in America have a sense of like taxes are a thing that we need to be worried about, but we don't really know how they work. We kind of put a lot of trust initially into TurboTax or H&R Block, and then all of a sudden we get to a more bigger, complex situation, and that's when we bring an accountant in or a CPA. And those CPAs are oftentimes very focused on just doing your taxes. And what our firm and what we really help people do from not only the 401k and the retirement side, but also the individual side is be strategic with taxes. So today we want to help you understand that because we don't want you to just blindly trust the advice we give. We want to help you understand it. So that's what the point of today is going to be. So let's dive into our presentation here.
Yep. We'll try and generalize this as much as possible, but if any of this, goes over your head, or if you have any questions, feel free to reach out.
Yeah, as always, you can call us, text us, email us. It's all the contact info is on our website, truenorthretire.com, as well as truenorthwealth.com. So there's two ways to get a hold of us. Retires, obviously, that's my side with the 401k plan, and then the wealth side's for individuals. But we all work together internally at True North, and we're here to help you. So here's the agenda today, and we should be able to get through this fairly quickly. The main thing is the tax brackets, understanding how those work, marginal versus effective or average, deductions versus credits, what those mean, different kinds of accounts, IRAs, taxable accounts. We'll talk about those, and then the order of operations, way you should save, typically ways that may be a great idea that you didn't know about existed, and kind of where your money should go once you've got a little bit of extra there to save. And we want to keep more in your pocket by not having as much go to the IRS if possible. Tax loss harvesting, that's an important term that I think people have heard but don't know what that really means. We're going to talk about that. And donations, two ways to donate and kind of make sure that you save on taxes as well as give to the charities that you want to. So I'll let Brett dive into the tax bracket system, and we're going to kind of go back and forth. So go ahead, Brett.
Yep. So we start off by mentioning that the U.S. tax system is a progressive tax system as opposed to regressive, meaning that income levels on the lower end tend to pay less in tax per dollar, and then it slowly scales up in a kind of graduated manner. So basically what I mean by that is that tax is not paid entirely on your marginal tax bracket. Okay. So I think it's important to mention that the difference between a marginal tax rate and effective tax rate to better understand this. Marginal tax rate is how much essentially you're paying in tax per dollar based on the last dollar earned in your paycheck. Okay. And then you also have your effective tax rate, which is your average tax rate. And to calculate that, you just take your total tax bill and divide it by your total income. Okay, so I think that's very important to understand. Once we kind of get past that, we have what's called the tax formula. And you'll see that's below. And that's a lot of, big words. I mean, we don't really need to get caught up in the, semantics of all that, but we'll just kind of run through this real quickly, and you can kind of start to see how we can create some strategies out of this. Okay, so we start by having gross income, which is often reported on your W-2. Okay, so this doesn't show up in your tax return, but we have your gross income minus your 401k contributions, and you get your wages. Okay.
And that's what's off your W-2, right? So we all get that if you're paid W-2. If you're paid 1099 or a K-1 or some other form, that is going to be a very different calculation for you. Well, it's going to be the same calculation, but it'll be processed differently. Most of us, though, W-2 is what we see at the end of the year for you or your spouse. And that way that's already going to give you your wages. So you plug that into your system or give it to your accountant and they know what to do with it.
Yep. And any income from freelance work and will show up in the tax return. So once we have our wages taken care of. We have our wages, we add our other sources of income like 1099 or freelance income.
Mhm.
We have our K1s if you're in a partnership. We have interest income, dividends, anything like that. And all those added together get us to our total income in the tax formula. Once we've calculated our total income, we subtract adjustments to income. And this is going to be things like IRA contributions, HSA, meaning health savings account contributions, and maybe student loan interest deductions. Okay, and so once we add in those or subtract those adjustments, we arrive at adjusted gross income, or AGI. Okay, from there we subtract the greater of the standard deduction, which everyone gets regardless of your, mortgage interest payments, etc. And then the greater of the standard deductions or your itemized deductions. Okay, itemized deductions being your state and local taxes, any mortgage interest, and any donations you might have paid or contributed to during the year. And you add all those together, whichever one is greater between the standard deduction or itemized deductions is what you will subtract from your adjusted gross income to arrive at your taxable income.
So
Now,
keep those terms straight. Adjusted gross income. So AGI is definitely a common thing you may hear from your accountant. And then taxable income is after the deduction. So you get to that AGI number, and then you're going to figure out, do I have enough deductions to get over what the government says I should already have? And because if you do, you're going to save a little more. So we're going to talk about some ways to increase that number down the road in a little bit later. But those two terms are important to remember.
Yep. And so there's all kinds of ways the IRS defines income, right? So adjusted, the reason they differentiate between these things is because, for example, adjusted gross income is often what what you have to base your IRA contributions on. If your income or adjusted gross income is too high, you might not be able to contribute to a traditional IRA and get a deduction for it. Okay. Coming back, we're at taxable income, and this is what's important when it comes to our tax brackets. Okay. So you have your taxable income, and that actually gets, for lack of a better term, drug up along the tax scale or along all the brackets. And we'll kind of touch over that on the next slide. But once we multiply our taxable income through the tax brackets, we get our tax bill, at which point we subtract tax credits and any money that was withheld from our paychecks. And we figure out if we have tax owed or tax due, or if we have a tax refund. So that's the tax formula. So don't get caught up on all the different words. Hopefully this kind of just gives you a basic rundown of how your tax bill is calculated and where we can pull certain levers within this formula to arrive at, or show our income the way we want it to.
Yeah, it seems really complex, I think, at the beginning, but the more you dig into it, the more you understand these terms, and then you apply it to what your actual scenario is, I think the easier it becomes to understand, and then the better decision making you can have throughout the year, because you know how that impacts your taxes. Too many of us make decisions and just kind of hope that at the end of the year, somehow magically our tax will get a refund. We don't know how or why that is. Most of us get refunds because we withhold too much from our checks, which means the government had your money all year. So finding that balance is important. And I think that's what's going to be useful as we look at the brackets here on the next page. So this is a great graph. I think you can Google this. This is one that we have, but there's two kind of sections on this top part here. It's single and married filing jointly. So obviously go to the one that you are. If you're single, you can see this first column is your taxable income. Now remember, going back to the other slide, that is your AGI, adjusted gross income, minus your deductions or your standard deduction, whichever is greater. Once you have that number, it tells you what your highest marginal bracket will be. But it's leveled out. So if you're single, the first $9,875 is charged to 10%, or $987.50. You can see that here in the second column. And then it gradually goes up and up. You can see the jump, though, after you make $40,000 in taxable income, goes from 12 to 22%. That's a significant jump. So understanding where the money is coming from in paying your taxes is really important. When people complain about paying higher taxes, this is what they mean. The more money you make, the more that last dollar you earned is charged. They're still paying the same amount that you paid on the first 40,000 or 50,000 or 80,000 that you did. They just may be in a higher bracket where it gets higher and higher percentage of that last dollar earned. do you want to add to that?
Yep. So, I mean, something I think is important to mention, and that's a common misconception, is that whatever your income lands at, say it's 50,000 if you're single, you see there that your marginal tax rate is 22%. But that does not mean that your entire income gets taxed at that percentage, right? So, as Jake had mentioned, just wanted to reiterate that the first 10,000, if you're single, will be taxed at 10%, and then it slowly increases for each dollar earned above each tax bracket. So, and that allows you to arrive at your tax bill, at which point you can calculate your effective tax rate. Okay, different from your marginal tax rate. So effective tax rate, as we had mentioned before, is just your total tax bill divided by your total income. Okay, you'll see down below we have a second tax bracket, so to speak, and this shows our long-term capital gains. Okay. So whenever you sell a stock or realize a gain in a taxable brokerage account, okay, so meaning not a retirement account.
No, not IRAs, not 401k, not
Mhm.
HSA. None of those would apply to this long-term capital gains tax.
Yep. So this just applies to taxable brokerage accounts. And essentially, if you're single, the first $40,000 you pay $0 on for any gains you realize. Okay, so that's another way in which we can, figure out ways to, when is it better to realize gains? Maybe in a year where your income happens to be below $80,000 if you're married, or $40,000 if you're single. Okay, so these are our two tax brackets. If you realize a short-term capital gain, meaning you held a stock or a security for less than a year, then it gets taxed as ordinary income. Okay.
So that would fall to this first schedule here.
Yep. So it would fall to the first schedule. If you do hold a security for longer than a year, okay, then it gets taxed at these more favorable long-term capital gains rates.
So that would also apply to real estate, for example. If you're selling a home, same scenario. Depends on where you fall. So you potentially, if your income level was above 40,000 or 80,000 for married, right?
Yep.
You'd be charged 15% tax on the gains from your home. So whatever you paid, whatever you sold it for minus what you paid is what 15% of that would be taxed at. Or 50% of that would be the tax.
And there's a caveat. I mean, if you have a primary residence, right, and you live there the whole time, you get what's called a Section 121 exclusion, which allows you to exclude $250K of gain from having to pay any taxes. So that rarely applies to a primary residence, but it definitely applies if you have rental properties, because you don't get that exclusion. It's $250K if you're single, $500K if you're married. So
that would apply if for a rental.
For a primary residence, you get
the exclusion. Exclusion is for primary.
Okay. So that, housing with capital gains would apply for a rental or investment properties in general.
Yeah, so that's important. And so knowing how those work can really impact your decisions of when you make those trades, and then maybe some other ways you can offset some of those gains while still keeping more in your pocket. So let's dive into the difference between deductions versus credits, because I think that's important, because a deduction would obviously favor those that are in a higher tax bracket. So going back to brackets, if you're in the, let's say 32% tax bracket, you're making let's say you're making $170,000 of taxable income. Well, a deduction, obviously if you saved $7,000, somehow you deducted that is really going to save, that $7,000 is being taxed as 32%. Then you're down below at the 24%. So knowing where you're jumping up on your taxable income is really critical to make good decisions, because deductions can impact that, as well as going back to the formula, IRA contributions. So we'll talk about that in a second. What else do you want to say on deductions?
Yep. So, I mean, it's a common misconception. We many of us might read the Wall Street Journal or Forbes, and we hear them talking about these things. And basically, tax credit, dollar for dollar reduction in your tax bill. Tax deduction just reduces your tax bill by your marginal tax rate in cents per dollar. So a tax credit is the same for everyone, regardless of your marginal tax rate. And a deduction, is more beneficial the higher your income, because $100 deduction, Jake kind of went over this, but just to reiterate, $100 deduction, if you're in the 30% bracket, saves you $30. Whereas if you're in the 12% bracket, it only saves you $12. So you can, kind of read these and kind of hopefully be able to differentiate now what the difference is between the two. So.
Yeah, and it really depends on your situation. If you have your own business or if you're just a W-2 employee, there's definitely more opportunities as a business owner to have different deductions, but you also have to have the income to deduct that from. So there's a very, I think, important thing to lesson learn from this whole presentation today is that your taxes are very personal. That not very many people are exactly alike. You're going to have different scenarios, different ways you can deduct things, and knowing how you're currently making decisions financially can impact your taxes is important, because on the flip side, the credit, that's different. That favors actually lower income because it's a credit, it's a dollar amount. So the child credit, I mean, there's a lot of credits that possibly could apply. There's the 529 credit. If you contribute, I think of $4,080, you get $204 credit. Yep. Obviously, if you're in a lower tax bracket, the percentage that's saving you versus your income is greater, but it doesn't matter what your marginal tax bracket is, you get that same credit. So,
and as a percentage of income, yeah, that would save you more money if you had a lower income. So, but credits are a lot more rare. So typically we look for tax deductions, and you typically get whatever tax credit is available to you based on your income. Yeah. But as you'll see, when we talk about IRA contributions, you can actually manipulate your income a little bit and get it to show up the way you want to, perhaps to get more favorable tax treatment in terms of getting these credits.
Right. Yeah. So that's important to know both of those. So let's talk a little bit about ways you can get essentially a lower tax bill by using retirement accounts and possibly taxable accounts, and how that impacts capital gains tax. So the first two here, traditional and Roth IRAs. You can also have both traditional and Roth 401ks. They both have benefits and they both have things to be aware of that may not favor your tax situation. This chart shows, you see the red arrows are when you are going to be taxed. So in a traditional, you're deferring the tax, meaning you're making the deposit of the money, which is a benefit to you right now because you're not going to be taxed on it now. However, you will be on the distribution. So whatever happens while it's invested inside of the account will not impact you. Let's say you put in an IRA and you bought a mutual fund and it went really, really high. The market continued to grow and you sold it and you moved to a different one. That is not a taxable event in an IRA or a 401k. It only is a taxable event in those accounts when you pull the money out and spend it and it's realized as an actual distribution or income. Then it will be taxed as income on top of whatever other income you'll have, whether W-2 or other sources of income. And then if you want to talk about, you can dive into that if you want.
So there's many heated debates about whether one should contribute to a traditional IRA or a Roth IRA, okay? And there are many nuances associated with this with debate as well. So the way I like to look at it, if I were to generalize it and make it as simple as possible, you'll look at the bottom of this slide here, and it says, consider, will your marginal tax rate be higher now during your working years, or will it be higher in retirement? Okay, and that's really kind of what it boils down to. So if your marginal tax rate, so meaning your tax rate on the last dollars earned, is higher now, then it's probably better to go with a traditional IRA, okay? Because then when you're in retirement, you're paying on a lower tax bracket when you pull it out. So you're doing a little bit of arbitrage right there. Hopefully that makes sense. So I would typically recommend a traditional IRA to those who are in their working careers, either maybe even early career. It really depends on what tax bracket you think you'll be in retirement. And you can determine that by knowing how much money you're pulling out of traditional IRAs in retirement.
And knowing what your spending rates, your burn rate. Mm-hmm. So, and factoring in your burn rate, plus if you're paying off your home, your burn rate should significantly drop because usually your mortgage is a huge part of that. And so knowing your actual spending in retirement, what you plan to do, is critical. I think it's kind of, if you're married, targeting the $80,000 right now makes a lot of sense because it's a bump up of 10% higher tax if you spend more than that. It doesn't mean you don't have after-tax money like Roth money where you could spend it from. So the key is you're going to need a mix of all these accounts. There's not one perfect fit. They're not one better than the other. They all have their different advantages. And it's always good to have multiple accounts because you're going to need different sources of money, some after tax, some pre-tax. But it does come back to the math. I think that's what Brad was really focused on, is that it's math doesn't lie, right? We can run the numbers to say if you're in a 22% tax bracket now and you plan to still spend and have the same tax bracket, there's not going to be a huge advantage one way or the other. The math could favor either way depending on what the market does. So there's a little bit of unknown there, but if your tax bracket is going to be different, possibly that's where we can be really strategic in knowing which one to choose from. So I don't always come out and say, well, you're young, you should do Roth. I hear that all the time. And that's somewhat a good thing to say, because the longer the time you have in the market could be beneficial because the growth is tax-free. However, if you're paying 37% in tax right now and you're going to drop down to 22 in retirement, probably not the best thing, even if you are young. So it's very personal. It's hard to always say. The last account, though, is the taxable account. So this is not retirement. This is what we mentioned earlier, where capital gains would come into play. You'll see the deposits tax because it's after tax money. So this is usually an account in your name, or a joint account with your spouse. Like, it's usually joint account with rights of survivorship. So if something happened to one of you, it automatically goes to the other spouse. Or a trust account, for example. These are all accounts that are going to be taxed. As you see, the middle red dot means it's taxed at the time of the trade. So when you go and actually sell something, then that year you'll be taxed on those gains. It doesn't matter if you leave the money in the account, doesn't matter if you buy another security with it, it's still going to be taxed because you had a trade that you made a sale on. So, and then it kind of goes to the capital gains tax is important to understand there, how long you held it, short-term or long-term, which we kind of already discussed. Anything else on the slide?
No, I think that, it's just important to understand the differentiation between IRAs, retirement accounts, and when things are taxed there. It's typically if the contribution or a distribution versus the taxable account, where contributions and distributions are irrelevant. That has more to do with the underlying securities or what's invested in them. And when trades are executed for that, that's when it triggers a tax event.
So I think most people, that's a thing they don't quite grasp. I know I learned it when I first started trading pretty quick, because all of a sudden I had to turn in all these basically transactions to my accountant to say, here's all these trades I did. And it was kind of all over the map. So that was a lot of extra work. The more you trade in a taxable account, the more work you're going to have at the end of the year to figure out, do you have losses or gains or both or mix? What are you going to do? So you'll understand that quick if you start doing trades like that in a taxable account. Next slide we want to talk about is the order of operations. So we get this question a lot, and this is kind of 7 generalized steps. This is by no means the exact way you should do it every single time. There's a lot of really individual nuances that can hit on this personally, whether your benefits at work are different. Maybe you have an HSA with a match. That would bump that up to number 1. Maybe you don't believe in having 6 months of emergency funding and you'd rather have that sitting in your 401k. You can do that. So don't take this as the only way to do it. I think the reason we have number 1 is the 401k match. I mean, because I live in the 401k space, I fully believe that's a really great idea, because if your company's doing a match there, that's free money you're not going to get if you don't take advantage of it. So we want to make sure we get that money. And a lot of times it's anywhere from 80 to 100% return, because they're doubling your money or close to doubling your money every single year. So that's every payroll even. So it's very significant. That can grow really, really quick, and it's all tax deferred unless you're doing Roth and you pay the tax. So that's why that's number 1.
Yep.
Go through some of the rest of them.
Yeah. So I mean, we wanted to do this as an order of operations for how to contribute to accounts. But before doing these accounts, there's some really important, foundations that you need to have in order to have, not be worried about having a cash flow constraint. Okay. So step 2, we recommend maybe having $1,000 in savings. That might be interchangeable with number 1. But again, as Jake said, with a 401k match, that's 100% return on your investment. So that's just leaving money on the table if you don't take advantage of that. Okay. So after we get $1,000 savings, we typically recommend one, tackles all of their high interest or consumer debt. It's typically credit cards, maybe auto loans if you have a really high interest rate. After that, we would recommend, having a little more padding with a 3 to 6 month emergency fund, depending on how, stable you believe your income is. The reason for this is twofold. I mean, one, you are protected from any, black swan events, anything that might happen where you get laid off, you have a huge medical expense and health insurance doesn't cover it entirely. But the second benefit is psychological. It allows you flexibility and allows you to not be as worried about taking risks, finding new jobs, starting a business when you have this kind of padding. So it essentially, like to think of it as flexibility money, and gives you kind of more of a present benefit rather than a future benefit, just, hoping that something bad doesn't happen.
And we still want that money invested. We still want it to be growing more than the banks and credit unions are paying right now, which I think is either 0 or 0.1. It's very, very small. And there's some ways, and we're still going to not get a whole lot because we want to have it very liquid, meaning you can get access to it today or tomorrow if you need to. And we use a Vanguard fund to do that, kind of direct to the Vanguard, but connected to your bank. So you're still always going to want to have your banking situation set up, but we want to have that longer term emergency savings earning a little bit more interest than just a checking account at probably 0.
Yeah, definitely. It's huge. Over the long run, having 6 months of cash just sitting there not earning anything can take its toll. So having that in a low risk investment could definitely be a good way to go.
And even beyond that, like, I think it's important to realize the 401k, even though you don't really want to take a distribution because you have a 10% penalty if you're not 59 and a half years old, but you still most likely have a way to access your funds in there as a loan, which is usually about, well, before COVID came to be, it was a 50% of your vested balance. You can take access to that and borrow it against yourself and pay interest back to yourself. That's never a smart move for things you don't need, right? You're not in like really dire straits. Like if you're taking money out like that to go on a vacation, not a good idea, because you're not only losing the growth in the market, you're also having to pay yourself back plus interest. So it is kind of a last resort idea, but know that it's something that you could get access to and pay back over a 5-year period should, things just go terribly wrong for you and you need to do some real fast fixing so that you can protect your family. So I like to throw that out there because I think there's a real stigma around you never, ever touch your 401k. There's a reason loans exist in your 401k. It's so you can get to them in a situation that you may need to.
Yeah, that's a good point. Yep. So, I mean, kind of going down these steps, we typically recommend one contributes to an HSA after they've done the first 4 steps. The reason being, if you'll recall our previous slide that showed, the red arrows, the blue arrows, and the yellow arrows, an HSA actually has blue arrows all the way across, and it doesn't see taxation once if you spend it on medical expenses. So with an HSA, money goes in pre-tax, you get a deduction for it. It grows tax-free, and it comes out tax-free if you spend it on medical expenses. Okay, so that's one of the best accounts.
It's the only way you can invest money in the stock market and never pay tax on it.
Yep, exactly.
So,
it's the only thing that never sees taxation.
And if you, for some reason, are the healthiest person on the planet and never see the doctor, don't have any medical expenses, at age 65, it essentially turns into an IRA where you could pull money for anything and have it as taxed at your current rate. So just know that the HSA is the most powerful tax savings account out there. They just have a smaller limit. So that's the other piece to it, is you can only put about $7,100 in a year per family. So that's not a huge number. If your employer contributes, that comes out of that $7,000. So I would always recommend the HSA be a really big part of your retirement plan, but it's going to take a long time for it to grow to a sizable portion that really makes an impact down the road. So be consistent with it, try to be smart about it and understand how it works and how to invest that money once you get past a certain dollar limit.
Yep. And then, I mean, with HSA contributions, you also need what's called a high deductible health plan, according to the IRS. So you can look that up if you
and that's
are
just to contribute.
Setting that up.
That's just to contribute. And you don't have to have a high deductible plan to spend it.
Yep.
So you can fund this when you have that, but if some reason it changes and you go to a different health plan or you go to Medicare or something, you have that HSA and you can spend it no matter what, even if you don't have a plan like that.
Yep. Yeah, no, thank you. That's perfect point to touch on. Number 6, we'll, typically recommend one finishes their 401k and traditional IRA or Roth if that's applicable. The reason being is that one could typically earn a higher rate of return in the market relative to one's mortgage interest rate. Okay, that's why we'd recommend maybe finishing those contributions before paying down the mortgage. Although, many people argue that there's an emotional benefit to maybe paying off the house early. And also you have a lower cash constraint. We definitely recommend having a mortgage paid off before retirement so that you have less money that you need to pull out of accounts, once you get to that point. But, once all is said and done, number 7, you can contribute to a taxable account to pay down your mortgage faster, or you can contribute to a 529 plan for college savings for children or grandchildren even. So this is typically kind of an order of operations we would recommend to make your contributing and your saving as efficient as possible.
And just to add to that, I've seen kind of the scenario where people wrestle with usually a spouse wants to pay it off and one realizes the math is in their favor to not pay it off and to invest that money. One thing I've seen in a way to kind of compromise that is to pay off the house if you have the money over a shorter period of time, and realize almost like the debt snowball, if you've heard that theory from like Dave Ramsey, I think, where say your mortgage is $2,000 a month and you pay that off. Well, let's get that thing gone. And then let's still put that $2,000 to work in the market rather than spending it in other things. Like let's keep that going because you're already kind of used to having that expense. Keep it going and then try to build the market back up or your account back up. And that can kind of offset risks of market timing too, because a good example is 2020. The market's been very volatile. It's been up and down quite a bit. And now we're kind of back up at higher levels. And if you're nervous of the market, you're like, I just don't want to do that. Pay down your house a little bit and then shift down the road and still put a little bit in the market as you get your house paid down and you feel more comfortable, but you're going to do it over time. Like you do with your mortgage, once a month, make a sizable contribution to all your accounts. So there's ways around kind of offsetting that fear or that risk in the market, which we're not getting a whole lot into today, but I wanted to just throw that out there.
Yeah, so I mean, it's a decision between two good things, so you can't really go wrong by picking one over the other.
You're going to come out okay in both ways, and one is a little bit better, but one's a little better from the math standpoint. One's a little better from, I think, a psychological. Hey, I don't have no debt. My debt's gone. So, tax loss harvesting. Let's dig into that. We have this and one more topic. This is an interesting one I think we hear about, and it only works with certain account types. So let Brett kind of explain. Let's see if you qualify and kind of give us the example of who would be a good candidate for this.
Yeah, so tax loss harvesting typically applies for those who have money in a taxable account, okay? So you'll recall our slide once again. We have our retirement accounts, such as IRA, traditional IRA, Roth IRA, all that, 401ks. And then we have our taxable brokerage accounts. This is where tax loss harvesting applies. So if you have some money in these accounts, any losses that you realize, meaning you sell the security within the account, even if you don't take out the money, you are able to write off those losses on your tax return, okay? So there's kind of an order in which you have to write off those losses. First, when you realize a loss, it has to offset any other gains you might have in the account, okay? So any other gains you might have realized throughout the year, you'll want to make sure that's offset first. Second, you're actually allowed to write off up to $3,000 in ordinary income on your tax return every year. Okay, so that's a huge benefit. You realize these losses and then you get a $3,000 deduction essentially. Now, if you recall, deduction versus credit, that doesn't mean you save $3,000. It means you save $3,000 times your marginal tax rate. Okay, so hopefully that makes sense. Now, you might be asking, why would we want to sell something at a loss? If we're, why don't we just keep it invested until it comes back? So this is where the strategy of tax loss harvesting comes into play. You realize that loss, and then the IRS has this rule called the wash sale rule. Okay, so if you realize a loss, you're actually not allowed to buy into that exact same fund immediately after selling it, okay? Because, the IRS is just thinking, oh, you're just trying to realize this loss. You're not actually, taking a loss. You're just doing it to kind of step around the, tax code. But this wash sale rule has a 31-day window. Okay, so you realize a loss and you are actually able to buy a similar fund, but one that's not substantially identical. Okay, so you sell, a total US stock market fund and then maybe buy an S&P 500 fund. So you realize the loss on the total US stock fund, buy the S&P 500 fund for 31 days. And after that 31-day period, you can sell the S&P stock or stay in it. Either way, they're not substantially different. But you sell the S&P 500 stock and come back into the total US stock. That allows you to write off these losses without actually ever getting out of the market and keeping those losses. So it's an interesting benefit. And this typically is more beneficial the higher your income, right? But it can apply to lower incomes as well. One more strategy, and I just want to make sure I'd covered everything here, but one more strategy at the end that we see here is capital gains harvesting. So it's the opposite of capital loss harvesting, okay? Capital gains harvesting is when we purposely realize gains in an account, okay? knowing that we are in the 0% long-term capital gains bracket. So if you remember back at the beginning, we had two tax brackets, our ordinary income and our capital gains income. Capital gains, we can realize gains and pay 0% tax up to 80,000 if you're married or 40,000 if you're single. Okay. So this is another big benefit because you can realize these gains, buy back into the market immediately. There's no wash sale rule for realizing gains. And that resets what's called your cost basis, or what, you know, your base for determining a gain, what you paid for the security. So hopefully that's helpful.
Yeah, no, I think that's a really important thing to understand. If you have a taxable account, which again is not your retirement account, so it's your individual, your joint account, or a trust account, you know, like an online brokerage account. This is something that can be done in a volatile market. Trying to time it can be really good, but it's going to be hard to do. So you got to play this into the whole picture of where your taxes are going, and if this is something that would benefit you or not. Knowing which capital gains tax bracket you're in, also knowing which marginal tax bracket you're in, can be important. But knowing your gains and losses, obviously the goal of everyone's accounts is to have huge, massive gains. If for some reason you went for swinging for the fences and your security you purchased was a huge loss, which I've had that happen to me early in my career, that's a great opportunity just to offset any other gains that you have in your other accounts. So it's tricky though. So if you have questions and you're wondering, is this something I should try, please reach out. I think we can really kind of take a quick look and give you some sense of what you could do.
One more important thing to consider, if we can go back for a second. So once you've offset all gains, you can write off up to 3,000 in losses against your ordinary income. If you have any losses above and beyond that, that's okay. It's not lost. You're actually able to carry forward any losses after you've written off the $3,000 in ordinary income. And that can be carried forward indefinitely until death. So that's important to remember too. It's okay to realize losses and do this tax loss harvesting above and beyond the 3,000 in ordinary income.
So this obviously works for those people that I think get more granular as far as their investing go, if they're buying individual securities. And that's typically the case I see when people try to do it themselves. So if you're that kind of person, you like to do it yourself, and you're doing maybe even thinly traded securities that don't have huge volumes, possibly you're just trying to go for some really speculative things with this, hopefully just a small piece of your portfolio. This strategy would be really, really good to know how to do. So I think that's important to understand.
Yeah, I think that covers that for sure. So.
Donations, last topic of today. There's two pieces of donations, and we live obviously in Utah and Idaho, and so there's quite a few people that do make, well, across the country, most people make donations to some form of a charity. A lot of us do it to churches, and so that percentage can get significantly pretty high. And so there's a way to do that in a way that will impact your standard deduction, or give you a higher itemized deduction, so you don't have to take the standard deduction every other year. So I'll let you, Brett, kind of, I think you explained that well.
Yeah, so let's kind of recall the tax formula that we showed at the beginning, okay? So after we arrive at our adjusted gross income, we subtract the greater of our standard deduction or our itemized deductions to arrive at our taxable income, okay? This is where our bunching donation strategy comes in, okay? So let's say you, for argument's sake, and to make things simple, that the standard deduction is $12,000 for a single person, okay? So let's say they have, and your itemized deductions consist of your state and local taxes paid, your mortgage interest paid for your primary residence, and your donations, and any charities that you contributed to. Okay, all those together sum up to your itemized deductions. And then whichever one's greater between that and the standard deductions, you get to subtract from your adjusted gross income. Okay, so where bunching donations might make sense, let's say you're coming back to my example, you have $12,000 for the standard deduction because you're single, and we have $10,000 in state and local taxes and mortgage interest, okay? So here, and you know, let's say we have no charitable donations this year. So here we're $2,000 short of being able to itemize, okay? Now let's say we do donate $3,000. So now we're $1,000 above the standard deduction. So between state and local taxes, mortgage interest, and our donations, charity, we have $13,000. That gives us an additional $1,000 benefit. That's hardly a benefit for the fact that we made $13,000 in these, deductible payments, but we only get a $1,000 benefit. Okay. So where donation bunching comes in is you are actually able to bunch 2 years of donations into 1 year. Okay. So instead of just doing $3,000 in donations, we do 6,000. And, granted, this is a lot
You
easier.
could spread it out though. I mean, that's the thing is like, you have to have the money to do it, but you don't have to have it all once. So you could still do it beginning of the year, January 1, and then the end of the year, December 31. So
yeah,
knowing that you don't have to do it all at once. So it's kind of like it's still every year, but you're just doing it in the calendar year so that you make sure you get the bunching effect of doubling that donation in 1 year, which gets you above that standard deduction.
Yeah, correct. So hopefully, that makes a little sense. We'll have, normally we would have 13,000 in itemized deductions, but instead we'll do another 3,000 for donations this year, in the current year. That lands us at 16,000, and that allows the second 3,000, that allows 100% of that to be written off. Okay. And then the next year we would just do the standard deduction. Okay. So we do no donations the next year, just let the standard deduction take over. And then we would alternate years for that. So 1 year we bunch, second year standard deduction, third year we bunch and itemize, fourth year standard deduction again. Hopefully that makes a little sense. That's one way to get a little more, bang for your buck, so to speak, in your itemized deductions.
In that simple strategy, you're putting the same amount of money into the donation, but you're creating a savings there that didn't exist before because you were just right there at standard deduction. So you can actually take that higher amount and it's going to save you a significant dollar amount just by that timing of that donation. So it's putting more money in your pocket without costing you anything, which is why I love that strategy one of the most. And the second step to that, I think, is even supercharging it to the next level, where you can actually, for your donation, use appreciated or stock that has gone up in value that would normally have a capital gains tax. So rather than realize that, you would donate that stock at the price that it was at when you donate it. So obviously that's going to be a higher price than when you paid. So Apple, I think, was like 360 today. If let's say you bought it for 200 and it shot up to 160, you normally have a tax, a capital gains tax, whatever, 15 or 20%, depending on your income, on that $160. You donate that, the 360 is the value. So your donation, they're receiving it at that cost. So they're happy. They're getting your value at that present price, but you are saving yourself on tax and everybody's winning in that scenario. It's a great, great move. And we see it a lot, especially at the end of the year.
Yeah. And so kind of to summarize, you have a highly appreciated stock with a large gain. The charity receives it. So you get the deduction for the full value. Then the charity sells it, but charities don't pay tax on these gains. So that no one realizes tax on that gain. So yeah, very great strategy if you have a highly appreciated stock in a taxable account.
Yeah, and that can work even with the bunching. In fact, you do both of them, and that's a great way for everybody to get what they want, and you're essentially keeping more money in your pocket that normally would just go to your taxes. So that is it. Those are the things we wanted to cover today. I hope that was helpful. Again, you can always reach out to us here on our website or wherever you're seeing this, truenorthretire.com. You can text me, call me, set up a time through Zoom on my calendar. We want to make sure that you have all your questions answered. A big benefit of working with us on the 401k plan is you get the real full hands-on personal advice that we give to all of our personal clients. Even though we're kind of two divisions of retirement and personal wealth management, we work together as a team, and a benefit you get in a 401k with us is all of that help. So the more that we know about you, though, obviously the more advice we can give. It's hard for us to give advice on not a lot of information. So the more you share, the better. And just asking us questions is completely free. We don't charge people by the hour to answer these questions. We definitely want you to consult, the tax advisor that knows you better, but there's a certain point where we'll be able to actually give you some good advice once we know your situation. So please reach out. Let us know. Brett and myself, we're based in Salt Lake, but I cover both Utah and Idaho. And really with this technology we have today with Zoom and everything else, we can reach you wherever you are, however you're watching this. And hopefully it's been useful for you. And We hope, as there's more questions, please leave them in the comments. If you're watching this on YouTube, leave comments or shoot us an email with more things that you want to hear us dive into, because we're going to keep doing more and more of these to really give you some good help in your life. Anything you want to add?
Yeah, I mean, we're both very passionate about this. Please reach out to us. We're happy to help. It's always fun. It's always a creative process to kind of figure out how we can put more money in your pocket. So, reach out to us and we're happy to help. Thank you.
All right. Thanks, everybody.